we talked about it when we were together on election night, Josh and I, that like the poly market was right everywhere, and the poll. I don't know who's going to believe a poll ever again.
So I'm a bigger boomer than you because I had the New York Times needle on my
you're
screen.
Younger than me. Is that what you're doing? You're flexing your youthfulness already.
No, I was the boomer that night. I was looking at the needle.
Yeah,
you were looking at currency markets and poly market.
Mexico dollar cross.
You were looking at.
I was.
He was looking at pesos to tell me who was going to win the election.
That's
and
the market,
and he got it.
Well, poly market is going to be a much bigger company in the future.
The question is interesting because there's a lot of economic data that we all react to that is survey based.
Yeah.
So if polling and surveying is now worth zero,
worth less,
and you can maybe we'll just poly market like
what's worth
CEO
more?
confidence,
What's worth
Michigan
more?
consumer maybe you'll just be able to gamble on everything, right?
Don't tell me what you think. Show me your portfolio.
Right. Yeah, you can gamble right now on whether I think like I saw this in the poly market earlier today on like does it take 100 days for the a war to end? Does it take 14% the Ukraine ends before Trump? Like there's a lot of increased interest in poly market.
I think in the midterms, poly market is going to be way more cited than people like Nate Silver.
So what we did is and this is super nerdy, but we looked at since the day that Biden announced he was out, and then the Trump first assassination attempt, we looked at the daily change in the poly market probabilities for the candidates and compared it to the daily returns for the S&P and the sectors.
Anything
so I was trying to. A little bit, but like, I just trying to be analytical because, when I do stuff, I don't like to get political, just because in the immortal words of Michael Jordan, Republicans buy sneakers also. Yeah. So we're going to,
also that's your
produce content and my clients don't care. We're trying to get stocks right.
Your clients are paying you for analysis.
Yeah, stock analysis. So I don't give my political opinions, but so I thought that'd be an interesting way to look at it. But you didn't have a huge sample size in the number of days, but you had a couple huge inflections. Obviously, the Harris debate, where the perception was she won, and then obviously the assassination where he peaked.
That's the first day that I believed that he would win.
Yeah,
the response to him being okay after that, and that iconic photo of him with his little fist in the air. I said he's probably going to win this thing.
Yeah,
but then I went back and forth a lot.
Coming out and giving him credit. Like there's a lot of that was an inflection.
But then I went back and forth a lot. Then I thought probably a month before that it would be her. Maybe. And then right up until the day before, I said, if it's a coin toss, I think she wins the coin toss, and I was wrong.
Yeah.
I didn't feel that strongly about it.
But it's crazy because obviously it wasn't a coin toss, and poly market or the bettors were right the whole time.
You could buy a Trump, victory in the absolute vote for 23 cents the day before. So for
the popular vote.
For the popular
Wait,
vote.
how does that pay? How does that work? How does that pay off?
So you got 4x in 24 hours. Yeah.
So it was worth $1 right after.
Yeah. 99. Yeah, you could go from 23 to 99.
Because that was the strike price of the contract?
Yeah, all of it is. It's binary. It's yes or no. So I think there was a lot more action on the who would win the election than there was on the popular vote.
Exactly.
Oh, wait. So, all right. So all these bets are priced as $1.
Yes. So they match.
And then they could be above or below $1.
I believe predicted market's totally different than poly.
No. It can't be above $1.
I'm asking.
No, it's either if something is 100% going to happen, then it'll trade at 98 cents, for example. Like there's always a margin.
Nothing will ever be at a premium to the payout.
The payout is $1. So they match.
I do think there are situations though where the combination of the two are greater than one. So
combination of what?
Meaning there was a moment where Harris plus Trump was greater than 100.
Yeah, 70, 50.
54 plus 51.
69, 32.
Yeah. But I haven't done one yet myself, so I probably should stop talking about something I haven't,
Okay.
Interesting stuff. Election, we're, a week after the election.
I think two things. I think that poly market is going to end up like Robinhood, like crypto. It's going to just be a thing, or like sports betting apps. It's just going to be a thing people do.
Sure.
It's going to become more mainstream, especially among young men who like to gamble.
But also, not just that. Think about your clients. We used to always talk about who's going to win the election. What does this mean for the dollar, for the peso, for the this, for that? Just
buy the election.
Just buy the election.
Yeah.
So
if it gets bigger and more liquid, you can use it as a hedging device. I mean, there's a lot of different things you could do.
So it's like the CME going to start doing this?
I mean, I guess
that's the thing. Yeah. See, this is when technological revolution.
Because poly market's in crypto. A lot of it's done in crypto.
When there's a revolution, there's always this air pocket where new entrants are unencumbered by existing regulations or think they are, and they get big really fast before the incumbents have a chance to negotiate with their regulators. The CFTC would probably have a heart attack if the CME like just started launching contracts like this.
I did a risk dinner with 7 or 8 guys who were like chief risk officers earlier this week, and like the one clear thing was just like crypto wins. Like I think people couldn't see a path for that not being great in the next 6-12 months. And these are people who I would say are, were generally been very skeptical 5 years ago and are now sort of warming to the idea that just the size of the asset.
They won.
They're warming to the idea because it's at 90,000.
Right. No, but they're saying more like it's become an institutional product, right? Like if you're somebody with, you're in some big, JP Morgan or Morgan Stanley or Goldman private wealth network, their advisors are now saying, well, if you have 20 million, you could put 1 or 2 in crypto. Like they're starting to make it a legitimate.
I was on the air with,
and that's different than
very much.
Yeah,
very
not everybody got the memo. I was on the air with somebody today. Crypto came up, and he's a gentleman of a certain age, and he's like, "But it's too volatile to be a currency." I'm like, nobody fucking says cryptocurrency anymore. You're reading the script from 2014.
Yeah,
we're saying crypto. Period. It's not cryptocurrency. It's digital assets, crypto or Bitcoin, and we don't care if it's a currency.
Yeah.
The use case is making $1 billion. That's it. You need a better use case than that? That's what it is right now.
Yeah. Yeah. By the way, it's just wonderful to see the color coordination of the bookshelf here.
Yeah, that's my madness.
Let's do it, John.
Right, let's get it started.
I love it.
All right.
Does everyone comment on that? Does everyone?
Hey guys, Crane Shares is hosting a webinar with Terry Branstad, who was Trump's ambassador to China during his first term. Branstad is unique because not only did he work with the Trump administration, he has a close relationship with Chinese President Xi Jinping as well. Branstad's relationship with China goes back to 1985. This is a man that knows what's going on and probably has a lot of things to share that you're going to want to hear. He plans to weigh in on trade, tariffs, and the future of the U.S.-China economic relationship. If you want to check this out, go to craneshares.com/compound. Oh, man. Episode 166? Oh, boy. Do we have an episode for you today? Ladies and gentlemen, welcome to the Compound and Friends. Shout out to all the first-time listeners. We love you. Welcome. This is your new favorite show. You don't know it yet, but I'm telling you that right now. To our day ones, thank you so much for sticking with us. Thank you for all the likes, the feedback. You guys are the best. Guys, we have a fan favorite guest with us today. One of my favorite people on Wall Street, one of the smartest people on Wall Street, and he knows it. Not humble at all about about his intellect. Adam Parker is the founder and CEO of Trivariate Research, a U.S. equity-focused boutique research platform. Adam was the chief U.S. equity strategist at Morgan Stanley from 2010 to 2017, and he is a frequent contributor to CNBC. Adam Parker, welcome.
Thanks for having me. Great to see you.
With me today, as always, my co-host, Mr. Michael Batnick. Michael, say hello.
Hello.
Nicole's here. John, Duncan, Rob. Whole gang's in town. We're so excited to have you all listening. And let me tell you, this is like one of those weeks, historic weeks. You had a rate cut. You had the S&P hit 6,000. You have some really big stocks go absolutely crazy. Tesla, DJT, all the blue chips. You have crypto hit 90,000.
Morgan Stanley, KKR. There's been a lot of real companies that are up.
Now on top of that all, cabinet appointments. Mm-hmm. Like this is like everything is happening right now.
Yeah.
NVIDIA earnings next week.
Yep.
We're just in one of those insane news moments. It's really exciting.
Yeah.
And I'm
awesome.
so happy to have you with us this week. Can I play something for you?
Yeah.
Okay.
In terms of just the overall macro picture, it sounds like you believe that despite some reemergence of inflation, growth won't be a problem. So you're not concerned about stagflation?
No, I think the economy is pretty good, and I think they're going to run it pretty hot. And I see the stock market is good, right? And asset prices are high. Christmas should be good. Employment is good. Wages are up. I don't know, unit labor costs are up 3.5%, and I think there's 2% of productivity on top of that, which means that wages must be at 5 or 6%. So, obviously not each person is in a great spot, but collectively, this should be pretty strong economy.
But in your latest letter, you wrote that by most measures, it is the most expensive stock market that we have seen since the founding of Greenlight. But it sounds like you're not outright bearish. So what does that mean for your gross exposure?
Yeah, we're not outright bearish, and it is the most expensive market of all time, as far as I can see, or at least since I've been managing. There's plenty of businesses that are pretty ordinary. They grow GDP or GDP plus 1 or 2, and they're trading at 45 times earnings and stuff like this. Mm-hmm. And then there's other businesses that have a little bit more excitement than that, and they're trading at 45 times revenues and things like that. This is a really, really, really pricey environment.
And that, of course, is country legend Chris Stapleton. That's David Einhorn with Leslie Picker at CNBC's Delivering Alpha yesterday. The most expensive market he's ever seen in his life. Was that the quote?
Yeah, I totally disagree with that.
I think he probably disagrees with that.
Yeah.
The most expensive market I've ever seen? David Einhorn, really?
That's not true on standard metrics like the median stock free cash flow yield.
Should we get him on the phone or?
No, I think if your intro included me having a humility challenge, I think we're gonna
okay.
We're gonna get redlined if we get the two of us on the same phone.
I didn't want to play like 20 minutes of
obviously
audio.
We don't make fun of wildly successful geniuses. So I'm saying I think when I look at the median stock, I don't see it that way.
We're David Einhorn fans, so I listen to everything he says.
You guys a genius and a billionaire. I'm just saying the median stock is not at an all-time high on price to free cash flow yield, and I think when you adjust for margins, a lot of companies have higher margins than they used to, and it's very true, tried and tested, that valuation is related to margin. So maybe if he's saying I think everything's wildly over-earning, that's true, but it's not true optically on today's valuation metrics. That I can say,
and he's not bearish. So he finished that by saying, but we still think the market can go higher from here. So that's not what a lot of value people values the only input that they use to think about markets. And so
I think there's a huge arrogance to being a value investor. Okay. It's really different than it was 25 years ago. I think when I started, I thought the growth guys were the arrogant guys. They had to envision some total available market and whether the drug or the technology works. And the value felt
Janus attitude.
I felt more humble, like value. Like, okay, I know how much default rate could be in the price. I know demand supply for metal. I can kind of bet now that. And it was sort of like you could use backward-looking data and be like a reasonable judgment value investor in the 90s or whatever. And I think now it's like totally the reverse. Like the growth investor, just like I know the themes that are growing. We can list them off. I want to own semis, whatever. We can list them up. And then I can buy the high-quality companies that are in those. And I just wait. If they roll over, I just buy more. I mean, that's all that's worked the last 15 years. Whereas value, I got to be like arrogant or, not arrogant. Maybe it's like much harder. I've got to like envision some recovery.
Do you agree with that?
It's different than it used to be.
Is value the most... Is value right now in the modern era the most arrogant prism through which to view whether or not stocks are a buy?
Maybe stubborn is a better word.
Stubborn versus arrogant.
So GMO, just funny you mentioned this, Adam. GMO just wrote a piece that I haven't had the chance to read yet, but they say it opens with deep value stocks are GMO asset allocation's highest conviction investment idea. And they look at this.
Is this from 1999, 2000, 2001, 2002, 2003, 2004? I mean, I was in Grantham's office 20 years ago saying mean reversion, sugar PE, that stuff doesn't work because it embeds margin.
GMO's highest conviction bet 10 years ago was emerging market timber.
Yeah. But listen, so you're right. I think that the iPhone changed everything. These companies fundamentally look different. The
cloud computing,
the margin profile looked different. And what GMO got wrong, and no disrespect at all, they're obviously legendary investors, is that it was all about margins of the most mean reverting series in finance. Turned out to not be true because they didn't understand what Apple, the Google, like they didn't understand it. So what they're saying is that the deep value, so the cheapest 20% of the market is in the 4th percentile, so almost never been cheaper. And for good reason, investors don't want it.
If I print off for you, we do this all the time, the mega large cap companies that trade below 10 times forward earnings, and I show you them, there isn't a single one. Oh, did you know that it's like kind of General Motors a little bit cheap versus history? You're not gonna be like, whoa, it's like totally
we're all aware, and it's just sitting there.
What's different, and here's what I think is different, and I just measure stuff, right? Like I don't, these guys are doing much more fundamental deep research, but it used to be a reasonable thing to say, hey, you know what? I can buy this stock because it's sort of discounting a normal recession. Now, the stocks where the multiples contract the most are still the worst during the recession because the market learned last cycle their earnings get most impaired. Like the numbers come down the most. So the actual optical valuation isn't a positive sign that it's in the price. It's a negative sign that it's about to get annihilated on the earnings. So like that's what I mean. Like
that's the arrogance.
Yeah, it's like you're saying that the market's wrong. That's the arrogance, right? And I feel like on average now, the market's right that there could be some great stuff in there. These guys are great stock pickers. Of course, Einhorn is a great. I'm just saying the basket of them are going to underperform. So it's harder to find the turnaround and gamble it's coming. That, you know what I mean?
One of the points that he made was that we're in a market that's now obsessed with only one thing, which is earnings growth. The thing is, we're paying 20 and 30 times earnings for companies that are maybe growing 2% faster than GDP.
Yeah.
So the thing that investors like the most is not just the fastest growing earnings, although we love that.
Right.
It's the consistency. We have companies that are so consistent, finding ways to grow earnings every year, like Microsoft and Apple and Meta. This is what the market prizes above all things, and that's why we pay 20 and 30 times.
It's gross margins. If we took a look at all the stocks in the growth universe that have beaten by 20% or more rolling over time, and we said, what did that 20% or more beat come from? Was it the multiple expanding alone, which would be, it's expensive? Was it earnings revisions, earnings growth? The answer is that it's gross margins. The ones that outperformed by 20% or more had the most gross margin expansion. Why is that a proxy for future growth?
Well, no, but why do investors gravitate toward those stocks?
Because the business model of companies that have high gross margins
They're monopolies.
is more
They're natural
repeatable.
monopolies.
It's more stable. There must be something about their pricing power or their product. So I think when you look at the price of forward earnings on next 12 months earnings, it looks expensive. But if a lot of businesses are higher margin, they're not as expensive on 2-3 year out earnings, and those are more believable.
What percentage of your customer base understands that?
I don't know. I mean, we focus, as you know, like on institutional investors, and I'd say pretty high percentage. I mean, it just depends. Some guys are really just like bottom up, biotech geniuses, and they're not really thinking about
that. That's a different
They're
world.
thinking about it's the drug safe or effective. But I think most generalist PMs who are trying to beat the S&P with a diversified portfolio are pretty aware that to get to the long-term average of 17 times forward earnings, you would have like a collapse in the market. The only way we can get there is if you have a collapse in profit margin for the biggest companies.
So listen,
right?
a lot of these people are using an outdated playbook. Remember, like Porter's 5 Forces was like the Bible, and it said that if you have these high margins, that will attract competition and it will drive margins lower. It's the opposite.
Right.
The high margin businesses are monopolies.
They have moats.
They have the high margins because nobody can come in and take them.
Like Taiwan Semi is a perfect example. Like if you decide you wanted to beat Taiwan Semi today,
fun.
Like good luck,
exactly.
right?
So it's YouTube too.
But
you go after YouTube.
But it's big. It's bigger than that, and people have talked about this. We long ago, I think the U.S. fought this landmark case against Microsoft 25 years ago, and it dragged on. Is that dragged? Dragged on? It dragged on.
It's probably in one of these books.
I don't think it's drug on. It dragged on for like 7 years, and by the time it was resolved, it was a moot point. The lawsuit was about anti-competitive behavior when Microsoft bundled Internet Explorer, the browser, with its Windows operating system. And the argument that the United States made was that this is reducing competition and it's ruining. The thing is, internet technology moved so fast. By the time that was resolved, Google had come along, and nobody gave a shit about the Windows the Windows Internet Explorer bundle.
Right.
It was a moot point, and browsers were free, and everyone had one. It didn't matter. But I think what happened as a result of that ridiculous waste of time and money is that we kind of abandoned the idea of antitrust, and we allowed a 15-year period where these companies not only built vertical monopolies, they started building horizontal
you can buy
empires.
You buy anything where the technology.
So here's a really good example today. Hims and Hers, which is a publicly traded company, telehealth company.
Direct to consumer. Yeah.
So if you have an embarrassing problem like female pattern baldness or erectile dysfunction, you use Hims. You can call, you can use the internet, and they will give you a prescription, which then gets delivered in a nondescript thing to your house. Okay, great idea. And there are 5 of those. There's Roe. Okay. That stock got annihilated today because Amazon said, oh yeah? We have a telehealth service. It's a low cost. You know the price up front. It's a clinical visit. And we bundle that with our drug delivery. So the prescription is built right into the visit,
Right.
and it's available to Prime users.
It's all Walmart.
Everyone's
and Amazon.
a Prime
It's all Walmart
user.
and Amazon. They're going to win. Right.
So, but like that.
Direct-to-consumer businesses generally
So-
are, these are Warby Parker. Same thing. Like, it's hard to,
So
for that to make
here's
money.
my point.
Yeah.
Here's a company that is a bookseller turned grocery store.
My dad bought the
turned
stock because he
cloud
liked the
computer.
Kindle. Okay.
Right. But now they're in healthcare.
Yeah.
And they're not just in healthcare. They're filling
Sorry,
scripts
Dad. Yeah.
and they're putting people in front of doctors.
Yeah.
No, nobody doing research at GMO could have foreseen that 20 years ago. No, it's
I think fundamental analysts should spend a big chunk of their time on gross margins for a company, and do they have a differentiated view from gross margins and consensus? If they're, and there's a lot of things to go into that: pricing, mix, input costs, labor, commodities, logistics. There's a lot of things that can make them go up or down. But one of the things I've learned in the last 25 years is, like, you don't want to short stocks where the gross margins are going up. Like, that's like,
but I think there's a legitimacy to TAM. I know it gets embarrassingly misused, but I also think network effects. I don't know how you quantify the network effects of something like Prime or Netflix or these are so Netflix is going to show the Tyson. Is it Jake Paul or Logan Paul? Jake Paul versus Tyson is Friday night. I'm not suggesting it's going to be like good boxing. I'm just suggesting it might be the most watched boxing match in the history of the world because it's Netflix. So it's free and it's global, synchronized all over the world at the same time. And Netflix can translate it into other languages immediately.
Right.
And
it'll be like a Formula One race.
So, so how do you compare that to a cable TV operator in 1989 with a straight face?
Look, 8 of the biggest 10 U.S. equities in the 80s were energy, right? They're high CapEx. So if I'm going to compare margin profile from today and say it's expensive versus the 80s, it's the ultimate apple versus orange comparison. So I think you got to focus on margins, and then the other thing obviously is the shareholder return, the management decision making. Are they good stewards of capital? And so, like, fundamentally else, I think can differentiate, and that's where they should be spending their time. And
but two things can be true: that the old playbook, throw it up, you're using outdated models, but also valuations do matter.
It could also still be expensive,
and valuations do matter. And are these stocks too expensive?
So I did a note a couple weeks ago, inspired by Costco, which I think.
What's that trading at? 45
times?
It got over 50 times forward.
Yeah,
I mean, come on.
And that's what inspired us to write the note. And I kind of set up as, look, we all like Costco. It's a great business. It had that Netflix moment of, they're going to stop, Brown and Batnick from using the same ID. Like, kind of monetize the door better. They get over 50% of their operating margin from that annual fee. And, it's a great business. Right? The employees like working there. But at 50 times forward. So we said, let's look at every company in the market ever over the last 25 plus years that had been below 50 times earnings for the last few years and had ascended up to 50.
What happens after?
Because per Greenlight's view, it's not like its growth rate really changed that much, right? It's kind of a pretty solid grower, but the margins went up a little bit, and that's associated. Basically, the answer is 6 to 9 months later, you start seeing pretty steady multiple contraction and underperformance.
Yeah.
Only about 24% of the stocks can maintain that 50 multiple 2 years later.
There's a limit.
So you start fishing from a pretty disadvantaged seat. So what we start doing now at Trivariate is anytime we see a stock that eclipsed that 50 time, we say, hey, you're in the kind of choppy water now.
It may not be a sell signal, but it's not the time to put new money.
On average, it was like 6 to 9 months later, it really started like a 10-month through 30-month decline.
Okay.
So it's not like the moment it gets there, you panic, but it certainly gets into your red zone or however you want.
I wonder if Einhorn would say the expensive stocks are way too expensive.
And that's totally probably what he means, is stuff like that, where like it went from 2 to 3% margin round numbers. It got massive multiple expansion. It's a great business, but to walk in today and say for the first time ever, like, geez, this Costco seems like a great investment idea.
This is what I would say.
And I agree with him on that for sure.
Valuation matters, but only when a company fucks up.
Well, yeah, downward revisions plus high multiple, you get the double whammy. Right. Yeah.
Until a company has a misstep or an executional failure, or like Boeing, or like some kind of crisis, CrowdStrike recently, that's when valuation matters. And until then, it really doesn't, because asset managers are chasing the names that are already working.
Yeah. The other thing, kind of per this sort of the market evolves and it changes, is it used to be, classic quant signal was I buy the cheapest quintile on price to cash flow.
How's that working out?
The best performing now are more like the 6th and 7th most expensive, right? The only danger zone for us is in the top decile EV to forecasted sales. There, I'd say when you get really extreme. In fact, I would argue I guess I particularly don't like the deep value point because the cheapest decile and the most expensive decile are
Stay
bad.
away.
They're
Stay
bad.
away. Yeah.
The reason they're so cheap is the market's telling you
They're
something's
trash.
wrong.
They're
The
trash.
tails.
Yeah, they're cheap for a reason,
Yeah.
and the reason is they stink, right? And the ones that are super expensive, they just start to get riskier on your point, like they're probably embedding really high forecasted growth.
Yeah.
That's a risk, or you have a bigger risk of your double whammy of like lower numbers and a lower multiple on it. So I don't mind a 6 decile expensive stock that's doing okay. Like the market's told you that since 2011, pretty steadily. That's the go zone.
Not to put words in their mouth because I didn't read the post yet, but I think they would say it's like there's always been trash, and the trash today is cheaper than the trash has ever been.
Right, and my point back to them would be, it's also worse.
Oh,
It's trashier.
Yeah.
I don't know. Is that true? Like, do they have more debt or do they have lower margin? Like, what is the
Or maybe the market's smarter.
I think more risk to their viability, more obsolescence,
more disruption
risk,
risk?
right?
Probably.
Yeah.
Yeah, I would agree with that.
And so I think it's like, it's easy for me to say, the newspaper industry is fairly cheap versus its history.
Yeah.
Going to zero.
Call centers don't feel like, wow, they seem like cheap, right? But or you know what I mean? Like,
Yeah.
I'm exaggerating for effect, but some of those businesses have real
So
impairments.
in the late '90s, we were selling steel stocks to people. They were the last ones left. There were 5 left.
Right.
They all since went bankrupt. Bethlehem Steel had a $7 stock price, and everyone you spoke to had heard of it. So, like, what if I told you could buy Beth Steel at 4 times earnings? Okay. 4 on the way to 2, on the way to 1, on the way to nothing.
I think some of the stocks that have rallied this year are like, I'm still not sure they're not going bankrupt. I mean, AT&T had a nice big move. General Motors has been a good stock.
Peloton.
And are you sure, like,
well, Spirit just went bankrupt.
right?
Should I buy it here?
Yeah,
GM went bankrupt 15 years. I mean, like AT&T, like, I think they go bankrupt in my lifetime. I mean, I hope I live long enough. Like,
Talk about debt.
they have so much
My
debt.
God.
Like, at some point, when you grow zero and you have that much debt, it can be a problem. So they can oscillate, but I don't know. So I'm just saying, sometimes the optical valuation, I think, is more a problem than it is an attractive thing.
I want to give you some props for what you said the last time you were on the show.
Oh, no.
Oh, good. It's good.
No, it's good. Our research associate, Sean Russo, combed through your comments, and you absolutely nailed
He
it.
combed the desert.
Michael, you want to run through these?
Really?
Okay, Adam, this is you.
I feel like karmically this is a bad idea.
No, for
'cause
real.
Everything I'm about to say is going to go to shit.
This show, this is not going to work out.
That's what I mean.
This is not going to work
this
out.
is the biggest short
All right,
idea I've
but the
ever
last
had.
time- the
Shorting
last time
me right now.
was January 2024. So you're right on the money. You said a bottoming economic activity gauge and loosening financial conditions are typically positive for risk taking. Check. Dovishness means higher price to forward earnings ratios, particularly for growth stocks. Nailed it. If the economy slows but doesn't hit a recession and interest rates slowly continue their path toward a normal yield curve, we could see materially higher equities in 12 to 18 months. Nailed it. And finally, the bottom line, we think the risk reward for U.S. equities is skewed to the positive for 2024. And that was not really consensus.
Well, I'll tell you what I'm worried about right now. And Josh, I'm sure sees this
Very
too.
proud of you, by the way. All useful.
Yeah.
I mean, that's 10 months ago. That's exactly the environment we ended up
If you
in.
do what we do, you're going to be bullish, bearish, right, wrong. You're going to live in all 4 quadrants, and I think you got to.
Take the compliment, dude.
I'm trying to fend off the short idea that I know I now am. But one thing I will say is, and you and I over-index toward talking to word salad people who don't invest any money and kind of have, revisionist history on what they said. But I will say there were a lot of these cross-asset types who were pretty negative on equities 2 years ago. And one of the things I'm worried about is they're universally bullish now. Like, when you go on TV now, it's like, wow.
But
everything's
just now,
good.
or they've gotten there
I would
over
say
time?
from like a couple weeks before the election, and now it's like,
Okay.
this dinner the other night, like I couldn't get somebody to say something bearish. I'm like, all right, let's say we get in the 5,300 at the end of the year. Like, what happened? Like, let's say, bond. All people could say is the dollar keeps strengthening. Like, well, it has been strengthening. I mean, like, I'll give you an example. I don't. There's a lot of things I don't know, and one of them is what the Japanese carry trade actually was. Okay, I searched every earnings call transcript from every U.S. company back to 2011. Everyone, the words Japanese carry trade had never been used in consecutive.
We
order
laughed at that shit in
any
real time
earnings
on this
okay,
show.
I didn't know what it was. I'm like asking all my friends, what the hell is this? Well, it's Jet Banks. Okay, so I looked just before I came on the show. I was just looking. We're kind of close back up to where the dollar yen was. It's like really close to like July. And so at the dinner I had with investors, I'm like, is anybody worried about things? And I was like, nah, that can't happen again. I'm like, okay. You guys are supposed to like manage risk for like
It
hedge
can
funds.
happen again, but we could all ignore it.
Yeah, but
Like we
everyone
did
ignored it
last
because it
time.
recovered so fast they didn't even know what to do.
Yeah.
But like,
So I hear you that everyone's
I don't know what it
bullish.
is. I'm just saying.
Why, but why wouldn't everyone be bullish? Maybe that's in and of itself is bearish, but why would you expect anything
Got
different?
6 weeks left. You have positive, favorable activity on tax policy and deregulation ahead. You still have interest rates coming down, although maybe they shouldn't, which we're going to get to in a minute.
So I hear you. What you're basically saying was, what's the bear case? And we could go. I think we know the bull case all over the place, and I think the bull case has a higher probability than the bear at the current moment. So, but what worries me is just. Okay, what's been a tried and tested formula the last 3 or 4 years? When Morgan Stanley, Goldman Sachs, and JP Morgan do their year-end outlooks, which is like this week or next week, and they're universally bearish, the market rips. Okay?
They might not be this year.
And if they come out bullish this year,
that's such a great point.
I mean, what's left?
Yeah.
Okay, and I'm a little bit worried that these guys. I made the sausage when it was like I see how it works, right? Like. It's the most painful process, right? There's like a 3-week thing. There's 20 chefs in the kitchen.
Conclave.
It's so brutal.
When everyone's on one side of the boat.
Right. And I'm just worried now that like it's hard to come in and
the bear case is there's no wall of worry.
Well, here it is. That's exactly right. So Callie, our chief strategist, made this chart from the conference board, and it asks, do you think stock prices will be higher? I think it's 1 year later. And the percentage of Americans that think that
we should polymarket this thing, man. What's going on?
It's basically at an all-time high.
Right.
It's at an all-time high.
Right.
So to your point, yeah, the bull case is fucking obvious. We all know the bull case is.
Wait, hold on. 50% of Americans think stock prices will move higher. And 2 years ago, it was like 25%.
So I think
because their trailing price momentum affects their mood. Right.
So
right.
The point is that there's no wall of worry right now. And that in and of itself is dangerous.
I think the biggest risks that people see that are like the macro types are strengthening dollar, maybe a hot jobs report December 6th being the next data point.
Well, inflationary policies,
and then you get them to pump the brakes on the Fed, and the Fed pumps the brakes. Yeah. I mean, that's
all right. So we got CPI this week.
Yeah,
came in line. October was 0.2% month over month, 2.5% year over year. The estimate was 2.6, so it was actually a little bit cooler. The lowest year over year CPI reading in 3.5 years.
Right.
Core came in slightly above expectations. No big deal. Shelter was still up. That's still annoying. And then PPI was today. And here, let me share this with you. This is Bank of America. Core PCE likely to print at 0.3% month over month. Again, given today's PPI report and yesterday's CPI data, we expect core PCE is what the Fed cares about. We expect core PCE inflation to increase by 0.3% month over month. The year-over-year rate should rise to 2.8 from 2.7%, due in part to base effects. That might be a problem. Yeah. Rising PCE, rising core PCE.
This is not what I'm telling people to position for.
But you have two more of these reports.
You're asking, let's brainstorm like what the bear case could be besides the obvious, which is you want to do the opposite if everyone's okay, which I think we all you have to admit it resonates a little with all of us. Right. Okay. So right now, the investors I talk to who are very kind of in this, I would say, hyper political mode for the short term, there's a very benign interpretation to what policy is going to look like. Everyone I know is like, well, Trump may mention a lot of tariffs, but in reality, there'll be deals, and it won't create a lot of volatility, and companies won't have to adjust how their government relations are with Mexico or China because there's going to be some deal that's going to be fine. Like everyone,
don't listen to everything he says. Is the consensus? That's
the consensus, and that's in the price, or at least directionally in the price. So if you get something breaks in a negative way in the first 6 months of next year, the interpretation could change, right? If all of a sudden the corporate's like, you know what, I'm moving 2,500 employees from Monterey back to Memphis because I just can't trust. Or Trump does something with Canada because he wants to poke the policy. Again, I'm trying to be politically neutral, but you could see some weird, they're our biggest trading partner in dollars with Loon. Like something could happen, and right now people are willing to, I'd say, innocent until proven guilty. As a general,
Adam, to your point,
right? I mean,
it wouldn't even have to impact earnings. The sentiment shift alone,
right? Where
people are like, oh wait, actually, maybe he is crazy
with multiples here.
Yeah, that's right. And if you just say, okay, it's a risk, right? Because if you were running a big company, and you saw like weird absenteeism in the U.S. and like none in one of your foreign, you might have on the margin moved employee. You're trying to get your margins up. Now you're just a little bit concerned about having stable relationships with Mexico or China, or so I'm in that camp of saying, I think they probably both want to have this thing work out and be smooth enough, it's fine, and they might work a deal out. But everyone thinks it's going to be benign. That's one risk. The second would just be the economy.
But he's not.
Causes them to pump the brakes on accommodation. Like the Fed stops, they pause. I mean, that could be bad. That's possible.
He's not renegotiating NAFTA this time. That was in 2018. In addition to all the China stuff, it was about redoing the trade policies of the Clinton era with Canada and Mexico. I don't hear him say shit about Mexico this time. It's just not part of his repertoire.
I think what people think, I'm just trying to reflect what I think institutional investors I talk to think is there'll be some sort of like golf round in Palm Beach with Xi and Trump. Yeah. Some chocolate cake that Trump will say is the best chocolate cake. And then there'll be some sort of agreement. Like, look, I'm going to say some crazy stuff about tariffs to Flex. You're going to absorb it. It's fine. You're going to buy $1 trillion of treasuries across the curve.
Beautiful treasuries.
And then I'm not beautiful, wonderful treasuries, the best treasuries. And then I'm not going to charge tariffs on almost anything. Give me like 2 random products you don't care about that I can take our 50% tariff on.
That I could
and
say
then I'll
when
say
I give
we're
speeches.
tariffing you because I'm the man. And then we're good, right?
Look at how cynical we all are.
But I'm saying, but that's what the consensus institutional investors. I don't even know enough. I'm just telling you that's what people think is going to happen. And so we're not going to have bond vigilante stuff. We're not going to have, the most volatile outcome. So I think the risks to the market could just be that there's currently optimism and a benign interpretation about regulation, about rates, about the smoothness, and history would dictate that we're going to have 1 or 2 bumps in that road. I mean,
the only thing he cares. The only thing he cares about more than his golf score is the stock market.
Right.
That's the score and
that's why I think one of the 5 reasons I think the bull market still has higher probability than the bear. I agree, but I'm just saying we all know we're not going straight up every year for the next 4 years.
Let me show you this chart. Let me show you this chart from I don't know where this came from. It's the likelihood of Fed cuts. I think Chart Kid Matt did this on top of the BLS. So 82% chance of a cut in December, up from 59% chance of a cut in December prior to the last CPI release. So when we know the Fed goes off PCE and they might have already decided what they're going to do anyway, is there a chance that they surprise the market and don't cut in December?
That WIRP function, which me and everyone else look at pretty regularly, the world interest rate probabilities, it just moves so much.
Yeah.
Of all the things on planet Earth that need to be poly-marketed, that's probably the number one up there. Because you go from like 8 to 4 over a month or two, and I think people believe we're not halfway done cutting this cycle. How about that? Okay. And so if we pause, I think the market will go lower on that news.
I do too.
Yeah, definitely.
Yeah.
I don't, because I think that introduces new uncertainty. Like, wait,
where are we in the cycle?
Are we done?
Right. If people think we're 3 into 8 or 3, we've done 325 units,
all right.
325 units into 825 units, if that's where people's heads are, and we're not quite halfway done, they can remain, it's early to fight the Fed. But if people think we're more than halfway done, all of a sudden it causes a bit of a multiple.
What gets sold off the hardest if they don't cut in December?
Regional banks.
Yeah, they're going to kill those stocks.
Small value.
Because they're like dreaming. I think they're almost already discounting too much because they don't even do M&A and transactions and some of the so it's a little bit. They're already.
You said this earlier, but another potential risk is the strong dollar. Doesn't hurt stocks right now.
It should be directionally negative for large cap companies.
It used to be.
I mean, it should be. The words that I look for in the transcripts are constant currency. So when everything's perfect, IBM, everyone will report, these are my earnings. As soon as currency starts hurting them, they say, well, here's my earnings, but in constant currency, they were good, right? So when it's negative, and if you think about it, when's the last earnings call you read and you're like, oh, they're reporting in constant currency? You haven't seen it because it's not hurting them yet.
Who sells a multinational stock on a currency earnings miss? Nobody, right? Nobody's serious.
It's smart of them to do it, for sure, to report it that way when it hurts them, right? But directionally, in terms of the earnings revisions for those companies, pharma, Staples, Select Tech, where they have disproportionate cost versus revenue in Europe in particular, that's the issue.
No, I'm saying from the investment standpoint, it's why did you sell Microsoft?
Currency,
currency?
Yeah. No, nobody's trying to an equity focused guy. No, but it could cause flows out, and it could make earnings revisions relatively hard. More challenging for the big versus the small. It could fuel that small.
Let's go. All right, let's go into your research.
Yeah, sure.
John, put this table up. This is 97 years of monthly returns for the S&P 500.
Yeah.
What are you telling us here?
Well, this was kind of the same thing we were all saying, like the market's going up, right? So this looks at all the years where the market was up a lot in January 1st to, this was the exhibit before that. So we looked at all the years the market was up a lot, January 1st to October 31st. And then we kind of said what typically happens in those years in November and December.
Melt up.
And when the market's up 20%, it usually does well. This is the exhibit before that just shows the November and December returns.
Let me quote you.
Yeah. Usually the market goes up. It's like a really high percentage of the time.
So we have the John. Put that next chart up. So we actually have this one too.
Thanks. Good work in the chart. Thank you. Yeah. So these are the years it was up 20 or more in that left column. And then you see the November and December returns. So you usually get another 5% plus, which
not a lot of negative.
Yeah, with not a ton of negative, right?
All right, so this is very easily explainable. This is just people doing what's best for their careers.
Yeah, 1943 was the last time you were down over those 2 months when you were up 20 in the first 10.
I'll never forget it. All right, 16 times in the last 96 years, if the S&P is up 20% plus through October of any given year, the market averages 5.5%.
Yeah.
Only 3 out of 16 times was the market down over the last 2 months when it was this strong.
Right, 1936, 1938, and 1943.
And there was stuff going on back then.
And there was some shit going on.
Yeah.
Okay. You very provocatively titled a recent research report, Sell the Inauguration, ?
Yeah.
So is this like the new shtick, like buy the election, sell the inauguration?
Well, it just felt
It makes sense to me.
Yeah, it just felt like, and I guess that we're dancing around a little bit between us is like, we have that icky feeling that a lot's getting discounted quickly relative to reality. There's a lot of optimism, but we also feel like this FOMO, it works every time. I still can dream. And so I wrote that on Sunday.
Yeah.
Is it going to be a sell the inauguration? I had this dinner Tuesday night. During the appetizer, I was like, maybe it's January 1st. And then during dessert, I was like, maybe it's the Monday after Thanksgiving. I was like, because as I heard, like everybody,
heard from
everyone was so bullish. I was like, whoa, you know what I mean? Because, I think we all remember that first couple trading days of 23, people forget now, but NVIDIA and Meta were awful stocks in 22. They were down 50, 60%.
Yeah.
And the correct move, if you were God, was cover December 30th and long max on, so I think a lot of people are worried there just could be like a bit of a nasty rotation early next year, and they're just sort of hoping that it lasts. And then I start thinking, well, if I'm aspirationally average PM, and I think that now, maybe it happens 2 or 3 weeks before. And I just, I'm just trying to. It's all game theory at this point, but I am a little worried.
So you might revise this idea when you see the Goldman Sachs and the Morgan Stanley.
If they're all bullish,
2025.
I don't see how I can justify being bullish for the first half of next year, or at least I will be. If there's a 20 variable problem, I'll weight that sentiment variable more heavily.
Yeah.
Because that wisdom of the crowds has been like wrong. What's the best thing? You're a contrarian bull and you're right. And that's like nirvana.
That's that's like that's the Belsky moment.
That's the best.
You're the only bull.
That's the best. Contrarian bull and you're right. The worst is, obviously you're out of consensus bear and you're wrong.
So you could survive. You could survive consensus bear, wrong, fine, no problem. Everybody else was a bear too.
Right.
That you could survive.
If you're a contrarian bear and you're wrong, it's super duper.
Well, they fired the 2 guys this year. They fired Mike Wilson, lost his job. He still works at Morgan Stanley, but he's not the guy anymore. And Kalanovic.
Oh, I thought Wilson's still the U.S. equity strategist, right? Oh, you mean just from the investment committee?
They changed his role. It looks like a demotion.
Yeah, I don't think that's a demotion, but I don't.
Everyone else does.
Oh,
and Kalanovic.
I'm a big Wilson fan. The funny, and Kalanovic too. I'm surprised because Jamie Dimon was kind of bearish on equities the whole time. So usually, if you're, in sync with your CEO, you get a little bit of a cushion.
This is the funniest part.
Yeah.
Jamie Dimon is out there saying batten down the hatches for the last 4 years. The guy that works for him is saying the same thing, and that guy got fired.
Right. And meantime, they're building like a flesh-colored middle finger-sized building on Park Avenue that's about 100 stories.
It's a Death Star. That thing. It's incredible.
I mean, the thing is, I guess my view is that I actually was more surprised of the 3 firms that Costin said equities were bad for 10 years and was like a 3% return for the next 10 years because I think if you're really doing the job and be provocative, you should be bearish once in a while. Like you have to have a framework and things should trip in, and you should be bearish and you should be bullish and you should be right and wrong. And you don't want to be a perma bull or a perma bear. I think if you have a framework and you're intellectually honest and you evolve, and I think that's fine to be negative for 6 or 12 months, but to say for the next 10 years to your giant private wealth network of rich people, you don't like equities, like that's a rough call to have.
But you don't understand what the game is now. The game is to sell private market assets. Now do you understand that better?
But I take the other side of that. Like I think there's like 10 reasons why, like the real bull case is we're on the precipice in the next 4 to 6 quarters of seeing companies get better predictive analytics, implement AI, and margins are going higher.
No,
and all these
you're missing it. The sales guys want to sell private credit and private equity.
Oh, I get that, but you guys know well from what you do. It's hard. Okay, I'll give you a story.
Look like you don't want to say it.
I'll give you a story. Okay. I used to go, go to cities. I do 6 institutional meetings. I used to hit like the top 50 advisors in every city when I was at Morgan Stanley, right? 10 years ago. And I'll never forget this. It was in Chicago. Big Chicago Bears looking fan. And all these guys in the room are pretty successful guys, so they wouldn't be invited. So this guy's obviously got a great book of business.
He's a hitter.
And in those days, and I think they still force you to rank your equity regions. And I always like I like the US or whatever. And I remember the emerging market guys like, listen, like we got to rank EM first, this, that. And I'm like, look, I don't know, okay. So we come up with a document. It's EM, then US, then whatever. I don't remember, Europe, Japan, whatever. And so I'm in Chicago. The EM guy's not there. I'm by myself in Chicago. And this guy, he's pulling out the papers and he's like, so you guys in New York, you guys like EM equities, huh? And I'm like, well, I'm the US guy, but that's the house call. Okay. And so he's got the document and he's like, so.
He looks like Ditka.
Yeah. Like he's like, to Bears, and he's like, so you want me to do what? You want me to sell, Costco and Google, and you want me to buy what? In Indonesian telecom and South African, and he's like crushing me in front of the whole crowd.
Yeah.
And so what did I realize? And I think about this guy pretty often. When EM beats the US by 30% a year for 4 years in a row, then maybe he'll buy some.
That's right.
There is zero chance that guy will.
His clients aren't saying, why aren't I own EM?
Exactly.
That would take a 3-year rally.
Right.
To get that to happen.
Massive.
I agree with you on that.
And so it's like they got to sell the product, and there's guys who want alts, but like people own US equities. It's big, it's liquid. They're trying to figure out to get in there. I think. Do
you agree with that? Like, what are you apologizing more for? Being long the US stock market in a bear market, or being overweight international in a
if I get you in a brick and then it blows up down 20, I'd probably pull my money from you.
100%.
We know.
Yeah. But I'm saying, you know what I mean? Yeah, you know.
Another sign.
he's like story checks out.
another sign that things are going pretty well. We have 6 sectors through November 13th that are up more than 25% on the year, and it's never been better than that. Chart on, John, please. You've never had a year.
This is a great chart.
Through November, where more than 6 sectors were up 25% of the year. So we're firing on all cylinders. There's not a lot of wall wire to climb. Ben Johnson notes via, this is from State Street Global, 2024 is a record-breaking year for ETF flows. $912 billion of net flows year to date. That's higher than the $909 billion record set in 2021. So yeah, everybody's in the pool.
Look at these numbers. Post-election, ETFs have attracted $58 billion.
Animal spirits.
Yeah. That's literally, the election's over, press the buy button. Like 1 million people doing that all at once.
But interestingly, you also have U.S. money market funds for the first time ever crossing $7 trillion.
Yeah, I saw that today too, yeah.
You have any views on that?
On the money market?
I'm not surprised. In fact, one of my predictions was that money market funds were going to remain sticky.
So one of my 5 freak out moments in my life was when I found out UBS money market accounts were backed by auction rate securities in 2008. And it caused me to buy some physical gold.
How did you find that out? You looked, or somebody pointed?
I read it. I just read it, and I was like, well, I mean, I could get like a 92% quote of my cash like tomorrow from you,
Yeah.
And it was like whatever custodian. It was weird. So. I mean, sometimes I just worry, like, what backs that and where is it? And if there's like a
what
run
backs
on,
the $7 trillion in money
if there's
markets?
a run, if people freak out, like it could make you nervous. I mean, I guess.
Well, it's backed primarily by Tether, And auto industry commercial paper. What are you worried about?
Yeah. I'm not. I guess it's a barbell, right? You kind of say, I have some profits, I'll lock some in, and and what rate are you getting on that? No, I didn't see what
4. Is it 4?
Yeah.
I guess, but are you surprised that given the strength of the market, that money is still not coming out? It's going in. Money is still going into cash.
I think the trailing price momentum is the biggest indicator of the flows, right? I mean, you saw that with the confidence.
It never comes out. It only the amount going into it lessens, but the money is making more money.
Yeah.
So if you own a money market fund,
nominally for sure. Yeah,
I'm in one of Fidelity's best institutional class money market funds. As it spits out its monthly income to me, it buys more of the fund.
Right. Josh discovers compound interest.
No, it's dividend reinvestment, but it's not dividends. That's why the money never leaves, because it keeps buying more of itself. You see?
I understand.
I like the S&P has some I mean, I don't believe anybody should have a tremendous amount of money in a money market account. I think unless you're actively trading and you're good at, I think when you deploy capital, you want to. I think the problem with letting, I discovered this many years ago. I was on the fiduciary responsibility I had was to the employees of Alliance Bernstein. I worked at Bernstein. It was on the 401k board, and it was right after 2008. And what the data showed was 95% of employees never change their allocation from the day they start working.
I believe that.
Yeah.
And so if you're super bearish and you get hired in 2008, you're like, oh, I want 100% cash, right? And then if you work there 20 years, you absolutely screw yourself with. So the debate we had was like, should we even allow an allocation above 10%? Like if they want to max out, it's 10, but they got to be in equities or bonds or something.
Yeah.
Because otherwise, and these are professional investment professionals, a lot of them, and still 95% don't change. Yeah. So I don't love the money market thing, but I could see as the rate it's at 4, if you have 20 or 30 million bucks and you just made a ton in Nvidia, you might barbell it a little
more to it than that.
Yeah.
If it's investment professionals, they already have all the market upside and all the market risk.
So they're that's what I'm saying. They're barbelling. They're hedging it with something more conservative.
Their real life.
Yeah.
This is the worst. This is the dumbest shit I've ever seen. If anybody says, "What's the dumbest chart you've ever seen?" I'll show them this. John, if you please.
I'm sure we produce some that.
No, this is not from Trivariate.
I'm sure.
Okay. This is Consumer Sentiment Index by party affiliation. This is the 5-day moving average from October 1st through November 11th.
What happened then? Just kidding.
I mean, this is genuine. When you do a sentiment poll of small business optimism or University of Michigan.
Polymarket.
All right. But I'm saying, this is what you're getting. You're not getting people's assessment of how things are going financially. You're getting their mood swing based on what they saw on Fox News or MSNBC.
I have such a heartwarming thing on this. I was at the Duke NC State football game in Raleigh last Saturday. My daughter's a Duke student, and it was it's a very military centric state. And with Veterans Day, they kind of rolled out some vets, and the crowd was going crazy. They pulled out 100-yard. Long flag and had all these soldiers.
Everybody loves that.
And here's the amazing moment. They roll out these two guys who were World War II veterans. They were 98 and 100. And the crowd just chanted USA on both sides of the
love
stadium.
That shit.
It was amazing. Interview that crowd.
But Josh, but it matters though. The reason why this matters
these survey polls are trailing sentiment.
But this influences people's behavior. If they feel better, they'll spend more. They'll be more optimistic. They'll invest.
Right.
It matters.
Let me tell you the ingredients to this. Morning Consult
for advertising, I guess.
Morning Consult asks people about their current economic conditions. Are they good or are they bad? That's literally how they ask it. And their expectations for the future. Will things get better or will things get worse? So heading into the election, Republican consumer sentiment was at 83. Any number under 100 indicates negativity. A week after the post-Trump victory, it's at 107.5. Democrat sentiment going into election day was 116. Now it's at 100. So the overall sentiment is now in positive territory for the first time since June 2021. Largely because of the swing in Republican people that say that they are Republicans to the survey. That's data.
But why do you think this is dumb? I know it's silly, but why do you think it's dumb?
Because people are dumb. They're not even answering the question. They're answering a question that's possibly related to the economy.
Surveys are dumb.
I've never back tested.
All surveys are dumb.
I've never back tested, but I don't believe there's any predictive value in terms of subsequent 1 week or 1 month returns from changes in the
No
consumer
way.
sentiment anyway. Yeah,
No
so
way. Oh, so this is my point.
It's kind of garbage in, garbage out.
You could take
from
these
stock.
consumer, not investor polls, consumer sentiment polls. Like, how do you like the economy? Well, if that son of a bitch Biden would just get out of the way. Like, that's how people are answering that question. You could just throw all that shit out, and you don't need to.
I think I've told you this before, but my favorite line ever on this, many years ago when I was at Bernstein, they had like a canned political debate in front of all the clients, and it was Bill Bennett, the Book of Virtues guy, and it was Al Franken. I think he was just becoming a senator from the comedian Transition.
Yeah.
And Franken gets up there and he's sort of waxing on poetically about how great the economy was during the Bill Clinton administration, and he's got his whole dog and pony show. And so he goes for like 5 minutes, economy's great, everything's awesome, Clinton's great. And then Bill Bennett goes, he kind of, obviously they planned this, but he goes, so I wake up every day on the beach, I walk my dog at sunrise, we watch the sun rise together.
Him and
I
his
just
dog.
don't give my dog credit for it.
Got it.
And it was just so perfect, like these cycles, like the most important thing for the economy is the Fed, right? It's not the president. Like there's a lot of other things that matter, and we try to like blame or take credit for stuff.
You think the Fed's more important than the companies, than the economy, the consumer?
The two things that I think I've learned in the last 25 years that matter for stocks are changes to perception about rates and changes to perception about growth. And the Fed can influence that a lot. And it's not the reality of the growth or the reality of
perception.
It's the changes to the perception about it. And so you can look at FF12, 24 GP, or Fed Fund futures 12 months from now and 24, and that kind of can be statistically significantly associated with the multiples, right? So think about 2021. You got worried they were going to hike, multiples for growth stocks got killed. Like, so there's a period where that's all that matters. And you can do all your fundamental work in a biotech stock you want in 2021, but it's getting killed because the growth, the perception about growth,
absent all the strategists turning bullish at the end of this year for next year, what would you need to see to turn bearish?
Earnings falling.
Yeah, I'd have to think the margins for the median company are going to go down, or are and that would either come from there's a very statistically significant strong relationship between changes in CPI and changes in margins. So if we start seeing CPI go up, a lot of small cap companies can't handle that. Their input costs go up, logistics go up, wages, become a problem.
This is what makes it so hard. Your job, and everybody's trying to figure this shit out, is that if margins start to come down, the stocks will get killed. And then it's like, all right, well, is this just like a dip and they're going to like stabilize and or maybe even accelerate, or is it going to get worse?
That's why the easy thing to do is you buy the ones that are high quality, that high margin, low volatility. I think part of the job of the analyst isn't just figure out what the margins are. It's what introduces volatility into the P&L. The reason why levered companies go down a lot is because when you get bad things to the P&L, their earnings.
Well, allow me to introduce. That's a great segue. So here's what could go wrong: immigration, and if they actually follow through on this idea of
some more wage
deportations.
pressure. Yeah.
So here's the New York Times. The piece is called Trump's Immigration Plans Could Bring an Economic Toll. Newly appointed Border Czar Tom Homan said the administration would start with the immigrants who have committed crimes. Okay, I think most people would agree. Good idea. Get them out of here. Okay. There are not nearly enough of those to amount to removals on a mass scale, however. We're going to run out of criminal immigrants. So then they're going to look at 11 million undocumented immigrants. That sounds like a lot of people, right? Yeah. I'm assuming many of whom are in the labor force. Quote, if you are in this country illegally in 6 months, pack your bags because you're going home, Mr. Vance said. Then the numbers could rise by another 2.7 million. These are people who are here on temporary humanitarian protection, which could be revoked. So all in, it's 13.3 million people living in the United States in some version of illegal status. And if you ask me, what's the thing that could really make people nervous about the earnings outlook is if they're serious about what I just read to you, who knows?
I think there's a not a direct impact from that for the biggest couple hundred U.S. equities. I mean, as far as I'm aware, there weren't a ton of illegal immigrants working at the biggest 50 or 100
No, but this
companies.
is how you get inflation back.
Right. It's more that downstream, if wage inflation goes up for small businesses, then they're more impaired to spend. Their confidence goes down, et cetera. So I think that argument would be more of a large versus small cap argument. It would probably, because I doubt, Meta's earnings trajectory will be massively altered by that.
Here's an estimate. Peterson Institute for International Economics estimates that the maximum case supporting 8.3 million immigrants would push prices 9.1% higher by 2028. Supporting only 1.3 million migrants would raise prices 1.5%. I think most people could live with the less bad scenario. I don't think they would notice.
I mean, prices are going up 2.5%
anyway.
per year. Yeah. So I think there's kernels of truth that are greatly exaggerated to that extreme scenario.
So it's not a thing that you think is going to be a market impact story?
I think wage inflation will matter for some businesses, but I think the potential and dream for labor productivity is so high right now. I took this course this summer, AI for healthcare at MIT. It was an online course, and I learned a ton. I'm like the new virtual analyst who thinks everything's awesome, but I started seeing, we've all kind of interacted in some form with the healthcare system, and I don't think I've ever left and being like, wow, this is like a Picasso, how they this whole system works, right? And I just think there's so many businesses, McKesson or Cencora, or McKesson's a $350 billion revenue company. It's a drug distributor, pass through 1% margin. If they can get better at predictive analytics, they should know where the major drugs need to be in every county in the world. They should get better at it. If their margins go to 1.8 from 1.1 on the $350 billion, you want to bet that's a good stock?
Adam, my dermatologist, they hand me a clipboard with a pen tied to the clipboard. When
somebody is physically writing something down,
it's incredible.
It's already terrible. They give these examples in this class and this is so basic and dumb. So I just want you to hear my dumb example and then multiply it by like 1 million to what can happen. There was a hospital system in Boston that had 250 surgeons. Okay, surgeons for some reason, this resonated with me just from my own interactions, family interactions. They do surgeries on Tuesday that like the big surgeries. And 3 days of recovery in the hospital. And they do like the minor ones on Thursdays. So the guy who runs the hospital is like, the only thing I care about is having like ICU bed capacity. And like I basically don't have any on Wednesday. So if something bad happens, like I'm kind of screwed. So a quant guy came in and is like, if I move 9 of the 250 surgeon schedules, we have the exact same available capacity Sunday through Saturday.
Right.
Does that sound better to you? Like it sounds so stupid.
That doesn't even require AI.
Right. I'm just saying just basics. Yeah. Okay, so now the AI stuff is like breast cancer imaging and avoiding prophylactic unnecessary double mastectomy. It's wild. There's going to be a box, I think, in 10 or 15 years in every single new home in your room that's going to be like a wearable multiplied by 1 million with electromagnetic waves. It's going to be like, hey, Batnick, you've been sleeping poorly. Have you done this? Or you've been, taking your. It's going to be like, so you want to short that healthcare technology complex and the ability to be more effective. And and what's interesting is the sentiment right now. It's almost like Republican bad for healthcare, Democrat bad for healthcare. Like it's like tails and heads both lose. And I just feel like that's weird because like Oracle's showing you there's a little bit of the Cerner deal that's starting to happen 2 or 3 years later. Like there's some, you think intellectually tech and healthcare aren't going to get better. So I'm like a little bit, I get that the grizzled healthcare guys be like, yeah, I've heard that and I've lost money on every one of those stocks. But I'm like kind of excited about the potential. All I think it's going to take for the market to rip higher is going to be a real company. Walmart would be amazing, but McKesson saying, hey, in the past I would have hired like 2,000 or 3,000 people to do this, and I got it down hiring 0. And then you're going to say,
that's such a great point.
Yeah,
like we're going to have an earnings season at some point this year where companies are actually going to talk about the victories from implementing all the AI in 2023.
Right.
They're going to be like, look how much better our results are now that we're doing X, Y, and Z.
Yeah, like Jensen, there was big doubts about the hyperscaler return on investment. People look at the Microsoft CapEx number and they're like, good God. And I get that. The biggest 10 U.S. equities are spending, I think, like the highest level of total capital spending dollars in the last 25 years. So like people are worried about the investment. And so you get like, NVIDIA down $10 or whatever. And then Jensen, the CEO of NVIDIA, flies to New York and Boston and he says, like, calm down, go to my website, click on the healthcare button, chill, and then the stock goes up. So I think there's just a positive skew toward getting a good proof case on this earnings productivity and labor productivity, much higher than Microsoft coming in and being like, our bad. We're shaving by 6p a quarter.
Yeah, it
doesn't work.
Whoops.
Like that will happen eventually where they'll plateau it and let others pick it up. But in the next 6 or 8 quarters, like, can you imagine if Walmart is like, we grew our revenue 4% and we hired 0 net people?
It'll gap up 13%.
Like, if you think their margins are going up 1%, this stock will trade at like 40 times forward.
And if you think it's good for Walmart, think what it means for NVIDIA.
Right,
NVIDIA.
which is already at 140 as we speak.
Did you have fun on the show today?
I love being with you guys.
All right.
Yeah.
Thank you.
We always have so much fun. Thank you so much for coming by. We always close the show with favorites, and I'd love to hear what you're into these days. What are you reading? What are you watching? What do you think the audience would benefit from knowing about?
I'm worried that because you've asked me that every time, and I didn't prepare for that because I don't really watch TV.
Where'd you go for dinner with your hedge fund friends?
I don't watch TV because during the pandemic, I watched a couple of shows, the heist one, Money Heist, and in the end, they all turned to soap operas, and I lost sleep. I was tired. I learned nothing, and I was like mad that I deployed the time poorly. And so I've kind of given up, so I'm like the worst person to ask about TV. I'm a big live sports nuts. Mike and I were talking about the NBA when I walked in. So I think like a good business model for me is going with my children to live sporting events. Like they don't feel the pressure of having to talk to me the whole time because of the entertainment in front of us.
The NBA
so I'm a
Cup?
big
It's the NBA
sports
Cup
fan.
right now. Are you excited about the NBA Cup?
I'm from Boston, so hopefully that doesn't annoy some of your listeners. I'm a huge Celtics fan my whole life. Larry Bird, Robert Parrish, Kevin McHale, the whole thing. And big Celtics fan. We are the current champs. I have a little bit of a Celtics looking tie on.
So you guys don't need the cup because you're going to win the whole thing.
We lost Atlanta, and I thought I was pretty proud of my response to one of my Knicks fan buddies who was teasing me about losing. I pulled out the old nobody who's won the par 3 tournament has ever won the Masters. Like we do the NBA championship. We don't do the mid-season cup.
We saw after the game. We saw Iverson at the casino. He was hanging with his buddies at the.
How come we didn't walk up? How come we didn't?
By the way,
walk up to him?
that's the real AI.
Yeah, exactly. The dealer said, "Do not talk to him. He will curse at you."
I've thought 20 times now, like why an AI company hasn't hired him as their spokesman. Yeah. Like that just seems the easiest marketing call of all time. You just have AI be your guy.
Ooh,
right?
I don't hate that idea.
Right?
Nobody did.
Can we monetize that? Yeah. I haven't seen him. Have you?
That seems so
Why
obvious.
isn't OpenAI doesn't OpenAI have Alan? Like, do we get a kickback on this?
I'm trying to think if that reference would be lost on half the audience.
Right, because everyone less than 35 doesn't know who he is. Yeah. Even though he was just like such worth paying for guy, right? Yeah.
I sort of like it. What do you got for us?
Did you finish the Penguin yet?
No. Do you want to spoil it?
No, I won't. But just the Penguin is one of those shows that I think people rightfully just wait until how a show ends.
I don't even know what the show is.
It doesn't matter.
Okay.
But the show is fantastic.
Sorry.
Worth watching to the
Colin
end.
Farrell.
Great.
Okay.
In like head to toe, fat suit, and makeup. He's unrecognizable.
You would never know it's him.
Right.
He played this role as a minor role in the new Batman movie.
Right.
And Warner Brothers made it an HBO show, like a spinoff from the movie. And it's like one of the few bona fide hit shows of the year because we just don't have that many great TV shows.
Here's a book you should read. I read it a few months ago. I think about it a lot. It's called Factfulness.
I love that book.
You know that book?
Yeah.
It's out several years ago. The guy died. But it's very positive. So if you notice, I gave you the USA chant. Like I'm in a positive mode about humankind. I really am. And this Factfulness thing, it basically asks questions about society. And you always think the answer is way worse than it is. Like how many people can eat? And you're like, is it 50, 40? And you just always pick, they give this 13 question quiz. And
Hans Rosling?
His Rosling, exactly.
What, you assume the answer is going to be worse than it turns out?
Yeah, they ask you 13 questions. You're a smart guy. You know what's going on. You're going to get like 4 of the 13 right. Okay. Now I skewed you to get 5 right. Okay. And because you always just think like, oh, it's like terrible.
Things are worse than they really are.
I don't know who said this quote, but somebody said 2 things are always true. The world is always getting better and people always think the world is getting worse.
Yeah. And that's kind of the summary that's Rosling's book.
It's a great book.
So I've been thinking about it because I do think sometimes in the day-to-day of like thinking about the stock market, I underestimate like the demographic certainties of what are happening. Like it's just, so it's something to
good rec.
Yeah.
You were dead right on Yellowstone. Seasons 1 through 3 are 3 of the best seasons of TV ever.
Yeah.
Season 4 becomes really unwatchable.
Has any show ever been good in season 4?
What's the guy's name?
Sopranos.
Okay, yeah.
4 through 7 are better than 1
What's
through
the cowboy that they
3.
follow? Is it Jimmy? What's his name?
That was back when I watched TV.
Yeah,
I did watch The Wire and Sopranos. I did.
Those shows got better as they went on because there was no internet. So they were
like 9 o'clock. Your wife yelled at you to get in front of the TV when it was starting.
Here's what's going on with this show. I could see the progression. Right. Costner is losing interest with every passing season, so his scenes start to become fewer and far between.
Right.
There was one scene where he was wearing the same clothes.
He can't work remote. He can't work remote. He wants to work remote. He wants to work remote.
Well, he lost his wife over the show.
Oh,
Costner's wife left him for the personal
Dude, you
trainer.
won't believe how bad it gets.
So, but you could see him in it less and less, and the show gets worse.
I guess the thing I'm most excited about in the world of what I pay attention to is we got a 12 team NCAA football tournament. That's new.
Yeah.
You know, your Canes should be in there.
The Canes are like one of the top ranked teams.
Unfortunately, and it's probably the last time I can say this for the rest of my life, but I went to Michigan. We're the defending national champions.
Yeah.
So we're 5-5 as I speak, and it's looking bad for the next two games. So, but I guess we can still hang out to the national championship. We'll probably never get again in my life.
As somebody who has a ton of friends that went to Michigan, you have a very Michigan energy, and I mean that. I mean that.
Slash asshole. Was that a slash? Was there a slash asshole there?
No, my wife went there. My wife went there.
Slash asshole or forward slash asshole?
Duncan, are you with me on that? There's a Michigan vibe.
I mean, I'm from Boston. I went to Michigan. For a lot of people, those are like the two worst things you could say. I get it.
But did you ever have this observation that people that went to Michigan are the most likely of any other college to wear Michigan clothes?
Oh, yeah, for sure.
You would agree with that, right?
It's amazing the blue. I mean, it's also the largest living alumni, so maybe it's just math. Like you just run into more people.
Wait, is that true? How do you know that?
I think the Googler.
Really?
Yeah, it's been a big school for a long time. So people in their 60s and 70s, 80s, there's a lot of
So like when you see people wearing their college stuff, they're it's the most likely to be Michigan people.
I mean, probably not by like a massive percentage.
No disrespect, by the way. Listen.
I mean, it's the leaders and the best. It's in the fight zone.
Guys, we want to thank Adam Parker of Trivariate Research for joining the show this week. Adam, you were spectacular as always. Tell people where they could follow you.
So if you're interested in what we do, you can just email sales@trivariateresearch.com.
And you serve who? Who are your clients?
Our clients are
Americans, Michael.
People who care about U.S. stocks. And we are eventually going to do a newsletter for the masses, so I'll be back on at that time to tell folks about
100%.
But I love talking to you guys. Anytime I can help with anything, let me know.
So we're trivariateresearch.com and info at.
Yep, LinkedIn. You can find us. We post content there. I try to go on once in a while with you on TV. I love being on TV, dude. You're very good at it.
Let's do it. Let's do it again sometime. Hey, I want to finish by letting you guys know we are hiring. If you're a video editor that can work locally with my all-star team here in New York City, we want to hear from you. We have work for you. Reach out at askthecompoundshow@gmail.com. Duncan will personally respond. We need help. The team is growing. The channel is thriving, and we need talented people who want to be a part of it. So if that's you, HMU. You know what that means?
Hit me up.
Hit me up.
Nice.
All right. Hey, guys, thanks so much for listening. Thanks for watching. We love you. We'll see you next time.